Welcome to Westbrook's COVID Conversations. Joining me today is Gavin Rabinowitz. Gavin is the founding director of UK-based Argo Real Estate. He was also previously a founder member of the Credo Group, where he worked for 15 years and was responsible for Credo's property investments. Gavin and I today will be talking a little bit more about direct property investing in the UK, and especially what COVID-19 has meant for the sector. Gavin, it's great to have you.
Thank you for having me. How are you?
Very well, thank you. Gavin, maybe to start, for those who aren't familiar with Argo, can you give us a brief background to the business?
Sure. Argo was set up about 5 years ago. We're a niche, opportunistic investment and management real estate business. Our clients are mainly private clients. We invest primarily in the UK, and we have two real focuses. One is long income. When I say long income, I'm not talking 15-year leases. I'm saying deals that are long in the sense, and we deliver 6-7% cash return, but we're not churning the assets. And then we have opportunistic funds where we look at specific transactions which have a time frame of between 1 to 3 years, and we look at delivering 12 to 15% IRRs. So it's high up on the risk curve, whereas the other one, which is more of a fund income type investment.
Gavin, we've spoken previously on our COVID Conversations around direct property lending. I'd love to chat to you a little bit more today around equity ownership of property in the UK.
Sure.
Obviously, you're a landlord and you've got unique insights into the behavior of tenants during COVID-19. Maybe to start, how's that process gone in the UK market and the interaction between yourselves, the tenants, and the banks?
So obviously, when it first broke, I think there was a sense of overriding panic and ignorance and fear of what would happen. Specifically with our fund portfolio, which is a 300 million assets under management, we immediately engaged with all our tenants and found out exactly what they were thinking, how they were managing. We were fortunate in that 60% of our assets are supermarkets to Sainsbury's and Tesco's. So obviously, as you know, those businesses have flourished in this environment. So there was no issue. Those tenants all paid quarterly in advance as they have. And then as we continued to engage, so we filtered out to see exactly who would and wouldn't be paying. We ended up with 80% of our tenants paying, and it was really a mixture. Interestingly enough, some very strong tenants, I won't mention the names, but they're household names who clearly have the balance sheet to pay, but were acting and trying it on to see if they could gain some advantage. Then some small mom and pop tenants, the butcher, baker, candlestick maker, doctor, surgeries, dentists, who clearly were not seeing anybody. For example, we own some real estate where it's, there's a go-karting business. Now, clearly people are not going go-karting. So what we did is, the first thing was to engage. Some tenants just said, we're not engaging, and others said, listen, help us. We're in this together, so let's collaborate. So where we have, we've given people rent freeze, but that has to be repaid to us. We haven't let anybody off their rent because we feel that there's a contract and times will change. So some of them we've altered from 3 months to 1 month in terms of helping their cash flow. Some of them we've said, okay, we'll defer it and we'll repay it over the term of the lease. Others we've said, okay, we'll defer it a bit longer, but extend the lease. But in all cases, we have engaged. The only outstanding one, which is proving difficult, and it's in the public eye, is Travelodge. We own, unfortunately, only one Travelodge in a good area, trades well, but you've probably been following. They are owned by Goldman Sachs and other private equity, and today they are talking now about doing a CVA. That's a company voluntary administration, and we'll see where that lands up. They're proposing paying 60% of rents till 2021, and thereafter paying in full. But there's a large steering committee and a consortium dealing with that, so we'll see how that pans out.
It's interesting. Gavin, I suppose we're both in the worlds of investors and investing into direct property. The world of alternatives has become something that's been spoken about more and more, with the traditional equities markets having struggled of late. I suppose your REIT style fund investing is more probably the world of traditional property investing, whereas direct property investments may be seen more as alternatives. I wanted to get your views in terms of, what are the benefits of direct property investing versus fund investing at these times? I mean, we've seen, especially REITs, globally have been hammered during COVID-19. Would you say the impact has been similar or different on direct property investments?
Look, I think the traditional difference between being in the public sector and private REIT or direct is the REITs were there to give you liquidity. And for the REIT owners and managers, it was there to give them paper to allow them to buy assets. Now, as we've seen with the big funds, not with the REITs, but the big funds have gated. So they're preventing people from redeeming because the problem is they can't get valuations because of COVID. Valuers can't get into sites. So it's difficult in actually quantifying the most probable loss. And secondly, a lot of them are in retail. So it's difficult to create that liquidity. I've always found the listed sector difficult because most companies, no matter how great they are, always trade at a significant discount to NAV. And since COVID, that has just been exacerbated. So on the extreme, you look at a company like Hammerson or Into, where they're 65, 75% trading at a discount. And that obviously is because they're heavily retail and shopping center focused. But even the big behemoths of British land, 40% discount, Great Portland Estate, Derwent. These are Derwent GP are good companies, and they're in at 30%, 25% discount. So I think that that's a difficulty, and it's very, very seldom that these trade at a premium. The ones that are trading at a premium are the secure income, long-term and indexed owned real estate, or Segro, for example, who's a logistics operator, and that sector is doing very well. The direct sector, I guess, gives you more control. The issue with being a direct equity real estate investor is the lack of liquidity. But if you have a sophisticated client base and you can invest and hedge and not overgear, I think you can get the returns that you want and be more in control.
Gavin, I mean, interestingly, as a small investor, people invest in REITs, to your point, because of liquidity. But as a small investor, the argument could be made that you're actually harmed by being in a REIT during times of COVID-19 because the liquidity results in material reduction in the value of your investment, whereas that's not necessarily true with direct property.
Yeah, I think, look, there is, if you're a listed REIT, there'll be liquidity. The problem is that, you move with two markets. You move with the real estate market and you move with the equity market. So, this morning the markets are up. So companies like Into is up, it's up from 8p to 10p. Is it because there's intrinsic value in Into? I doubt it. But because the market is up 10%, so it goes up with that. So, you're left to the vagaries of the equity markets. My preference has always been to be a private investor, whereby you're in control, you're managing it. You don't have to exit when you might be forced to. You can hold it if you're sensibly geared. And also, you don't really need to worry about valuations. If you've got a 5-year plan, the fact that after 2 years the market is down doesn't really matter. You'll look to yourself and say, okay, my investments has gone from 10 to 8, but actually I'm not liquidating. I'm everything, my pipeline is on track. Everything is going according to plan. I can sit there and go through and wait and see. Whereas being in the listed sector, as I said, it's subject to the vagaries of the market. And at the moment, the equity markets are up. Is it a real reflection of what's going on? I think you've got systemic change in a lot of property in the UK, specifically, the retail shopping center sector.
While we're on that, I'd love to talk about one or two asset classes, and maybe you mentioned systemic change in retail. How do you see retail evolving into the future? I mean, we've seen in the UK logistics, last mile logistics becoming more and more of a theme. How does that play out with retail? Are retail centers perhaps going to start to be converted more into logistics?
So retail encompasses different sectors. So first of all, you have high street retail, which is your local shop. So I think other than pretty towns like Cambridge and Oxford and Salisbury, the tourist type town, I think the high street is decimated. So the days of banks and betting shops are gone. Big superstores and department stores are gone. The high street, I think, is going to have to change radically. Either they use it for residential or experiential, which everyone talks about. But as a concept, high street investing, I think, is over. You then have shopping centers, which, the likes of again, that has been smashed. And I think unless they do something dramatic there, it's also going to be over. I think people don't go to shopping centers like they used to, unless they're going to go see a movie. And then what happens with COVID in terms of spacing. So I think that will take time to move out. And look at the big mall operators in the States like Simon Properties, they're having to rethink everything. And I think that is a problem. Then you have the retail warehousing sector, which I think is interesting. So the key is to find retail warehousing that is not over-rented. So for example, in January, we bought a property in Beckton, which is just by City Airport, East London. It's led to a large B&Q, but it's urban. It's right in London. And we were able to buy it because retail is being damaged at a yield of 7.5%. So if you can buy that, the key thing is to focus on the rent. So if your rents are not over-rented, in other words, they're not of £30 a foot, but 20, and the industrial is £18 a foot, then over time, you can reposition that and make it a last mile logistic, a storage. And what happens is that, so we're buying something at 7.5%. Let's assume B&Q leave for whatever reason. You then make that an industrial. You can convert it, you can get planning consent, and you do that. You re-rate from a 7.5% cap to a 5% cap. And some of these industrials are trading at a 4% cap. So you can see the upswing is huge. So I think that's going to continue, the sort of the focus on urban logistic, last mile logistic. Interestingly enough, if you analyze the logistics cost base, their delivery is key for them. And the component in their business of rent only constitutes 5%. So there's a lot of space for that to grow in terms of the rental. So we've seen tremendous growth in the multi-let industrial in the Southeast, which are going to be used more and more. We've seen how it is now. This COVID has accelerated our reliance on one-day delivery. As Bezos would say, we're in the business not to deliver in 3 days, but to deliver not in an hour, but in 15 seconds, and then to return it in 10 seconds later. So I don't think that changes. And I think what this has done is accelerate what was naturally going to happen anyway in the retail sector.
That's been a theme I've heard a couple of people say to me over these COVID conversations, is that COVID hasn't necessarily changed the themes. It's accelerated the themes that were already there. Gavin, you mentioned that 7.5% cap assets. Just to give us a bit of context, pre-COVID, what would you have been able, in your view, to acquire that same asset for? I'm just trying to understand how cap rates have moved.
Yeah, so I think it's not just pre-COVID, it's pre-retail disaster, for want of a better description. Those retail warehouses would trade between 4.5% to 6% because they typically had long income. You had 15 years to a Boots or 10 years to a B&Q. So those have moved out dramatically. Now, good local urban will still trade at a 5, 6.5, but retail's been tarnished so much that there's some really bad retail that you can pick up for 10, 11, 12%, but basically you wouldn't buy it. I mean, shopping centers, the biggest problem I think with Into is, aside from their debt breaking covenants, et cetera, and the fact that people are not shopping, is that you can't sell a shopping center. So nobody wants to, and remember, Into don't have shopping centers in the middle of nowhere. These are prime shopping centers, but you cannot, the old saying, for love of money, you can't give these away. So yeah, cap rates have come in, but interestingly enough, the property sector is not just retail. You've got, obviously there's residential, and then there's office, and there's industrial, and there's leisure. So leisure, the hotel sector has obviously taken a big knocking. The restaurant sector, the movie sector, the gym sector, all of those have moved out, those yields. And people don't know what's going to happen, when our hotel's going to start operating, and how long is it going to take to get back up. The office sector, I think, is interesting because the cap rates haven't moved dramatically. I see today a Hong Kong buyer just bought a 120 million transaction in Farringdon. So remember, the pound is kind of weak and attractive. There's some other buyers who perceive the UK as a safe haven. You look what's going on in Hong Kong. So these are all other factors that affect investments. You have very low interest rates. 30-year money is 0.4%. Ever since I've invested, interest rates have gone down and down and down. And so if you're buying something at 4% and interest rates are zero in the bank, does it look a silly investment? The interesting thing is what happens with offices. We were talking earlier, are people going to stay at home? Are they going to cycle and want to be in a spa before they go into a meeting? Are people going to have to walk around with hand sanitizers all day long? Will people say, you know what, guys, stay at home? Twitter have said, Amazon has said, Facebook, stay home, 40% of our workforce. So does that negate the office, or do people need bigger offices because you need social distancing? So we're in a time of flux, but London is London, and I'm a long-term London bull, and I believe, and I've seen it through the global financial crisis, how things have moved and opportunities present itself. It was a long, uninterrupted talk. Sorry.
I would love to ask you 100 more questions, but unfortunately time isn't on our side. I really appreciate you joining us today.
Thank you. Thanks for your time. Take care.
That's Gavin Rabinowitz. Gavin is the founding director of Argo Real Estate in the UK, talking to us a little bit more around direct property investing, today's COVID conversation.